If you look carefully at market movements throughout history, you'll notice a fascinating and troubling pattern. When a crowd moves in one direction, when all your neighbors start talking about the same investment, when social media fills with people celebrating their silver gains, that's exactly when you should pause. It's not a prediction, it's a logical consequence. History teaches us that the biggest financial disasters happen when everyone believes the same thing at the same time. And today, as you watch this video, millions of Americans are chasing silver after seeing it surge over 150% in 2025, reaching close to $75 per ounce. But here's the uncomfortable truth. When everyone is doing the same thing, someone is on the other side of that transaction. And that someone usually knows something the crowd doesn't. This isn't a video to discourage you from investing in silver. It's a video to teach you how to think like great investors think, to understand the principles that separate those who build wealth from those who lose it. Because if you understand the incentives, you understand the behavior. And if you understand mass behavior, you can make smarter decisions. History is an excellent teacher, and it repeats the same warning about crowds and investments. Let's go back to 1979. That year, silver hit its previous historical peak at around $50 per ounce. But what caused that explosion wasn't solid fundamentals. It was an explosive combination of speculation, inflation, fears, and herd behavior. The Hunt brothers tried to corner the silver market. The media amplified scarcity stories. Small investors rushed to buy silver coins at numismatic shops. Everyone was talking about silver. And then the market collapsed. Silver fell more than 80% from its peak. Thousands of Americans who bought at the top lost their savings. Fast forward to 2006. Same story, different asset. Everyone was a real estate expert. TV shows taught how to flip houses. The collective belief was that prices could only go up. It wasn't different. It never is. All these events follow the same pattern. First comes a real fundamental change. Then initial gains attract more investors. FOMO, fear of missing out, takes over. And finally, when even your grandmother is buying the asset, the market hits the top. If you look with composure, you'll see we're watching the same theatrical play today, just with a different actor on the main stage. Silver. Now, let me be clear about something important. Silver has genuinely strong fundamentals right now. There's a real structural deficit between supply and demand. Silver production fell from 1.07 billion ounces in 2010 to about 1.03 billion ounces in 2024. Meanwhile, demand reached approximately 1.2 billion ounces, creating a deficit of 160 to 200 million ounces. Industrial demand is growing. Solar panels, electric vehicles, artificial intelligence, data centers, all consume increasing amounts of silver. More than half of global demand now comes from industrial uses, not investment. These are real factors. They're not made up stories or pure speculation. But here's the fundamental principle you must understand. Even when fundamentals are solid, timing and the price you pay make all the difference between success and failure. The question isn't whether silver is a good investment. The question is whether it's a good investment now at these prices with this crowd. Let's apply what I call the intelligent contrarian principle. When you see an opportunity that seems obvious to everyone, ask these questions. First, what information is the crowd ignoring? Today, the crowd is focused only on silver's positive aspects. But are they considering that central banks might raise interest rates if inflation persists? Are they considering that a recession would drastically reduce industrial demand? Second, how much of the positive future is already priced in? If everyone expects solar energy demand to skyrocket, isn't that expectation already reflected in the current price of $75 per ounce? Third, what's your plan if you're wrong? The crowd never has an exit plan. They buy because it's going up and sell when it's falling. That's a recipe for disaster. To illustrate this point, imagine a country that discovers revolutionary new technology. Let's call it Techland. In the early years, only a few smart investors recognized the potential. They invest when technology company stocks are cheap. The fundamentals are solid, but few pay attention. As the technology proves its value, more investors begin to notice, stock prices rise, media starts covering, shows do specials. Now, even people who never invested are buying tech stocks. And it's exactly at this moment that the original investors, those who bought when nobody was paying attention, start selling. Why? Because they understand a fundamental principle. When everyone wants to buy something, there aren't enough buyers left to sustain prices. This is silver's situation now. The fundamentals are real, but the crowd has arrived. Let me give you another more direct example. In 2020, when the pandemic began, I had an interesting conversation with a major institutional investor. He told me, Ray, I'm buying stocks when everyone is panic selling, not because I like stocks more than anyone else, but because extreme fear created irrationally low prices. That same investor called me recently about silver. You know what he said? Ray, I'm starting to sell part of my silver position, not because the fundamentals changed, but because I see the same speculative behavior I saw before, other corrections. The difference between successful investors and the crowd isn't intelligence or access to information. It's emotional discipline and understanding of human behavior cycles. So how does this apply to the average American thinking about investing in silver today? First, recognize where you are in the emotional cycle. If you're feeling urgency to buy silver because you can't miss this opportunity, you're probably being influenced by crowd behavior, not rational analysis. Second, understand your personal context. If you're thinking about putting 5% or 10% of your wealth in precious metals as part of a long-term diversification strategy, that might make sense. If you're thinking about putting 50% or more of your savings in silver because it's going to the moon, you're speculating, not investing. Third, consider the opportunity cost. When you buy physical silver today at $75 per ounce, you're betting it will continue rising more than other available options. But what if stock markets enter a correction and you miss the chance to buy excellent companies at bargain prices? Fourth, observe the warning signs. When you see YouTube videos promising silver at $500 per ounce, when Facebook groups are dedicated solely to celebrating daily silver gains, when people refinance their homes to buy silver, these are signs that speculation has taken over. The wise American does the opposite of what the crowd does. When everyone is buying with euphoria, you reduce positions or stay out. When everyone is selling in panic, you consider buying. But this requires something most people don't have: patience and humility to admit you might be wrong. The difference isn't information, it's self-control when the market goes crazy. If you still believe silver has a place in your portfolio, here are guidelines based on principles, not emotions. First, define your why before buying. Are you buying silver as an inflation hedge, for diversification, as speculation? Different objectives require different strategies. Second, use the small percentage rule. Don't put more than a small fraction of your total wealth in any commodity, including silver. This limits your risk if you're wrong about timing. Third, buy in stages, not all at once. If you decided to invest in silver, do it gradually over several months. This reduces the risk of buying everything at the peak. Fourth, have an exit plan. Before buying, decide at what price you'd sell if you were wrong, and at what price you'd sell to take profits. Write this down and put it somewhere you'll see it. Fifth, ignore daily noise. If you're going to check silver prices every day and get emotional with each movement, you're not investing, you're gambling. Sixth, study history. Read about other commodity markets that had booms and busts. Silver isn't special. It follows the same psychological patterns as all other assets. Seventh, maintain perspective. Remember that real wealth comes from decades of consistent, disciplined decisions, not from one bet that works out. The intelligent investor understands it's not about getting every play right. It's about not making mistakes that destroy you financially. Now I'll explain something crucial that the silver crowd doesn't understand: economic cycles and how they affect commodities. We're currently in what I call a long cycle transition. The last 40 years were characterized by declining inflation and falling interest rates. This environment was perfect for financial assets like stocks and bonds. But this cycle is changing. We see persistent inflation, deglobalization, rising military spending, and aging populations. This could be the beginning of a new long cycle where commodities and real assets outperform financial assets. If this analysis is correct, then silver and other precious metals could have decades of superior performance ahead. But here's what the crowd doesn't understand. Even within a favorable long cycle, there are short cycles of 5 to 10 years. During these short cycles, even assets with excellent fundamentals can fall 50% or 70%. Look at the 1,970 seconds. Gold and silver were clearly in a long-term bull market due to inflation and currency debasement. But even during that decade, gold fell 45% from 1,974 to 1,976 before continuing its rise to US dollar 850 inches 1,980. The crowd that bought silver in 1974 thinking it couldn't go wrong had to endure 2 years of losses before seeing gains again. Many sold at the bottom and lost money even during a long-term bull market. What does this mean for today? Even if you believe we're at the beginning of a commodity super cycle, it doesn't mean silver can't fall from US dollar 75 to US dollar 45 or US dollar 50 inches the next 12 to 18 months. And if that happens, the same crowd buying today out of FOMO will be the crowd selling in panic tomorrow. The wise investor understands these cycles and uses declines during bull markets to increase positions, not sell them. That's where most people get it wrong. Not because they're wrong about silver, but because they're right at the wrong time. Let's talk about something the crowd never adequately discusses: risk. Everyone talks about silver's potential to reach US dollar 100, US dollar 150, or even US dollar 500 per ounce. But how many people are talking about what happens if it falls? Risk mathematics is unforgiving. If you buy silver at high prices and it drops substantially, you lose a significant percentage. To recover that money, silver needs to rise much more just for you to break even. And here's something few consider: opportunity cost. If you hold money in falling silver while other opportunities are emerging, you're losing twice. During the 2008 crisis, silver fell more than 60% from its peak. At the same time, excellent companies like Apple, Microsoft, and Johnson & Johnson were being sold at ridiculously low prices. The investor who was protected with silver lost money and missed the chance to buy these companies at liquidation prices. This doesn't mean diversification with commodities is bad. It means you need to understand that diversification means accepting that some parts of your portfolio will perform poorly at certain times. Silver can be part of a diversified portfolio, but when it represents most of your wealth because you followed the crowd, you're not diversified, you're speculating. There's something happening in the silver market that deeply concerns me: hidden leverage. Many people are buying silver through ETFs, futures contracts, or other derivatives without fully understanding the risks. Others are using loans or refinancing properties to buy physical silver. When you use leverage to buy a volatile asset like silver, you amplify both gains and losses. And during market panics, leverage can force you to sell at the worst possible moment. Recently, we've seen borrowing costs for silver hit record levels. This means the market is under stress. When there's stress in the system, leveraged people are the first to be forced to sell. I'm also observing signs that some major institutional investors, those who bought silver earlier, may be starting to reduce positions during recent volatilities. Why would they do this if the silver story is so compelling? Because they understand something the crowd doesn't. Timing is everything. And when speculative positioning becomes extreme, even assets with good fundamentals can have severe corrections. Let me share some specific signs I'm observing now that make me cautious. First, the difference between physical and paper prices is expanding dramatically. In China, the premium for physical silver reached extreme levels above the spot price. Second, silver inventories at exchanges are at extremely low levels, which might seem like a positive sign, but also means stress in the system. Third, media coverage about silver has reached saturation levels. When this happens, it usually means almost everyone who wanted to buy already has. These aren't arguments against silver's fundamentals. They're arguments against buying an asset when speculative positioning is extreme. If I were to make a decision about silver today, here would be my mental framework. First, I'd recognize that both bulls and bears have valid points. Bears say positioning is extreme and a correction is likely. Bulls say fundamentals are exceptional and we're at the beginning of a super cycle. Both could be right at different time horizons. Second, I wouldn't try to predict exact timing of price movements. Instead, I'd create a strategy that works in multiple scenarios. Third, I'd maintain focus on risk-adjusted returns, not just potential returns. A strategy that might generate 200% returns but has a 50% chance of losing. 60% isn't necessarily better than a strategy that generates 80% returns with a 20% chance of losing. 15%. Fourth, I'd remember I don't need to participate in every market movement. It's better to miss an opportunity than lose real money. My personal approach would be something like this. If I believe in silver's long-term fundamentals, I'd buy small amounts during any significant weakness over the next 12 to 24 months instead of buying a large position now. When sentiment is extremely positive, this requires patience. And patience is exactly what the crowd doesn't have. Here's something crucial many investors don't understand. True diversification means owning assets that behave differently in different economic environments. During high inflation, commodities like silver tend to do well, but bonds do poorly. During deflation, bonds do well, but commodities do poorly. During strong economic growth, stocks do well. During recession, cash and treasuries do well. The silver crowd's problem is they're putting all eggs in one basket based on a narrative about one specific scenario, persistently high inflation. What if they're wrong about this scenario? What if we have a severe recession that causes temporary deflation? What if technological innovations drastically reduce industrial demand for silver? The wise investor builds a portfolio that can survive and thrive in multiple scenarios, not just the scenario that seems most likely now. This might mean having most in stocks of companies with good fundamentals, a portion in bonds of different types, small positions in commodities, including silver, something in real estate, and always some cash for opportunities. The exact percentage depends on your situation, but the principle is the same. True diversification protects you against being wrong about any specific scenario. History teaches us valuable lessons about crowd behavior and investments. During the tulip mania in 17th century Holland, tulip bulbs cost more than houses. During the internet bubble, the internet was genuinely transformational, but that didn't prevent the NASDAQ from falling dramatically from its peak. The pattern is always the same. A real fundamental change creates a genuine opportunity. Smart investors benefit early. Then the story spreads, FOMO takes over, and eventually even people who shouldn't be investing enter the market. It's always at this point when the last person enters that the market hits the top. Silver today has real fundamentals, but that doesn't mean it can't follow the same boom and bust pattern we've seen hundreds of times in history. Let me share something about mental preparation I learned during decades watching markets. An investor's biggest enemy isn't lack of information. It's the inability to control emotions during market extremes. When silver is rising, it's easy to convince yourself you're an investment genius. When it's falling, it's easy to panic and make bad decisions. The wise investor makes decisions based on principles, not emotions. They decide their strategy when they're calm and rational, then execute that strategy regardless of how they feel in the moment. This means writing your investment plan when you're not under emotional stress, deciding in advance how much you'll invest, when you'll buy more, when you'll sell, and under what circumstances you'll change strategies. And this is the hardest part, sticking to that plan even when your emotions are screaming to do something different. The crowd never has this kind of discipline. They buy when they feel optimistic and sell when they feel pessimistic. It's exactly the opposite of what you should do. One of the most important distinctions you can make as an investor is between what's probable and what's possible. Is it possible that silver goes to US dollar 200 per ounce? Sure. Is it possible it goes to US dollar 30 per ounce? Also possible. The question isn't what's possible. The question is what's probable, considering where we are in economic cycles, current market behavior, and speculative positioning. And even if you believe US dollar 100 per ounce is the most probable scenario, that doesn't mean it's prudent to bet a large part of your wealth on that outcome. Good investors make asymmetric bets, situations where potential gain is much larger than potential loss. Buying silver at US dollar 75 when everyone's talking about it doesn't seem like an asymmetric bet to me. An asymmetric bet would have been buying silver at US dollar 25 2 years ago when nobody cared about it. Or it will be buying silver at US dollar 45 18 months from now if there's a correction and everyone is pessimistic. Timing may not be everything, but it's much more important than most people believe. If you've made it this far, let me share the most important lesson of all. True wealth doesn't come from hitting one spectacular play. It comes from decades of consistent, disciplined, well-thought decisions. The crowd is always looking for the next get-rich-quick, but history shows this mentality is precisely what prevents people from getting rich. The most successful investors I know are patient, disciplined, diversified, and humble enough to admit when they don't know something. They don't follow crowds. Instead, they build robust systems that can survive and thrive during different market conditions. They focus on what they can control, their emotions, their decisions, their discipline, instead of what they can't control. If you want to invest in silver, do it as part of a diversified strategy with money you can afford to lose and with a clear plan. But please, don't do it because everyone else is. Remember, when everyone is running in one direction, sometimes the smartest thing to do is stop, observe, and think for yourself. History teaches us this requires courage, but it also teaches us that this courage is exactly what separates successful investors from the crowd. In the end, the choice is yours. You can follow the crowd and hope this time is different, or you can think independently, act based on principles, and accept that investment success is a marathon, not a sprint. I know which choice is more likely to lead to true and lasting wealth. History is very clear about that. The question is, which choice will you make? It's not a prediction, it's logical consequence. In history, the greatest risks disguise themselves as opportunity. Sometimes the smartest decision is to wait for the asymmetric moment